Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We this is our 8th year of doing Equity Mates. This is our 8th year of exploring equity markets, learning about the share market, learning how we can, as two idiots from outside the industry can learn to invest in shares. But recently, we've embarked on another part of the journey, our property journey, and it's very exciting for you. It's in fact a happy anniversary for you because you're 1 year into your property journey now.
Yes.
And so to celebrate and to ask what next, we have the mortgage broker that helped both you and I take our first steps onto the property ladder, Chris Bates. Welcome back to Equity Mates.
Good to be here, lads. And yeah, happy anniversary. And 8 years of podcasting. I started The Elephant back, I think it was 2019. I'm trying to remember. And the years just ticked by, right? And the amount you learn through all the guests you've had over 8 years would be amazing. It's one of the best advantages for us when we're producing podcasts is getting someone in a room that, if you ask them for a coffee, they probably would say no. But if you ask them to come on the podcast, they say yes. Imagine
that is literally why we started it.
Yeah, that's interesting. Yeah, exactly. And many people I've met over the years, it's just amazing. And it's also the chats off air that, the listeners here don't get the advantage of, right? The little small talk around the edges that you can ask some really, crunchy questions if you want. So thanks for the invite and happy to be here.
Now, for people who are unfamiliar with Chris, he is one of Australia's top mortgage brokers. He co-founded Blusk, which helped us get into property, as we said. And look, we've got a bunch of questions from the community. There's always property chat. We went out to our Facebook discussion group and our Instagram to ask people what property questions they have, both from an investing lens and from an owner-occupier lens. But where we want to start today's episode isn't with those questions. It's, Bryce is a year into his journey. He's bought the place. He's starting to pay off the mortgage. And so we want to do a bit of a check-in with you live on air. What should he be thinking 1 year in? Is there anything he should be ting 1 year in?
Are you enjoying the property?
Yeah, loved it.
And you like your neighbours?
Yeah, love it.
Tricky question on air. You're going to be...
No, I was just thinking of it. We still haven't actually met one of my immediate neighbours. That's why the hesitation. Yeah. But yes.
I mean, these are some of the things that you just don't know till you're in a property, right? So you can definitely check the location and the street and the aspect and the floor plan. But sometimes when you get into a property, you go, hang on a sec, I don't really like this street. I didn't know about that. Or I didn't know my neighbour is a nightmare and we're not getting along. And sometimes and it's not really working for me, this property, and for where we are in our family stage. So do you see yourself staying there sort of, what's the vision?
Well, we haven't considered leaving. And I can see ourselves being there we bought it. We probably pushed ourselves to the extent to the max, knowing that it'll be something that we don't have to trade out of for a while. Yeah.
And so I think that, anyone buying a property, right, it's first thing, do you really see yourself staying here? And hopefully it is a yes, right? But ultimately then it's trying to think through, well, how long do you see yourself staying here for, right? And, I guess it's where stage you're at in your life, right? Are you a single, are you a couple, are you thinking about having kids, are you having multiple kids? Schooling. You might not have wanted to think about that a year ago, but you might be a year down further in your life and you're starting to think about those things. So I think that's what usually happens is then you start saying, well, can I modify this property or add value to this property that will match what I need and will give me a longer runway in the property? And two, could increase its value. Now, it's really hard to increase value at the moment because the cost to renovate, right? But also, renovations take time, right? You've got DAs potentially. You've got to, make sure you can afford it and equity, etc. So, I don't know. Are you thinking down that view at all?
We've definitely been speaking about if we were to reno it or, do something to it, then what was already going to be probably 10 years can be a lot longer, I think. But I think we've thought through all of those things because we have mates who have renoed and it's been a 2.5 year process. And then it comes down to the ability to service it as well. So for renos, a pipe dream for us at the moment, but we see it as something that we'd probably be able to do to stay there even longer rather than having to then go and find another place to live.
Yeah.
Yeah.
And then you've got the cost of stamp duty, cost to sell, so just selling, not renovating isn't a simple option. You've got to go and find a property. You've got to, so it's very painful. So, upgrading or buying another property that is renovated is really stressful as well as going through a reno. So, I mean, that's usually what people are doing is they get in, they get their furniture in, and then, 3 weeks after they move in, they start thinking about how can they add value to this and what should we change. And I do think taking your time with that process is really good. So ideally, when you do buy your first home, it's something you can live in and you don't rush into a reno. I've got a family member, my sister's actually doing this right now. She went against my advice, and if she's listening, sorry, Claire. But she bought a house in Maroubra, and she definitely wanted to renovate it from the start. And unfortunately, she's 3-4 months into that mortgage, and she's only just starting the reno, and probably should have just lived in it first and just experienced it. And if it's not the most beautiful place, that's okay. You get that, take that time. So, I mean, that's probably for yourself is just thinking that through. What would you need to do from a council point of view? Get some architects in, speak to some real estate agents, just start to formulate that plan. And even if you just do it in bite-sized chunks over the next year, I think, and tracking the market on what's selling really hot in your market, right? So what are the properties that really run? And trying to get to, not the property you got today, but property you're going to renovate into. And you go, actually, no, that's what people in this market really want. I've got to make sure I've got that.
Yeah. All of the ones in our I guess row as well have all gone through some form. Well, most have gone through some form of reno. So there's a blueprint that we can look at from the DA point of view and see.
So I've got a couple of just dot points around 1 year in. Is there anything he should be thinking about? So we don't advocate timing the market, but Bryce and I both seem to nail the interest rate cycle. When we got our mortgages, had been 13 rate rises, but since we both bought, there haven't been any more rate rises. But still, he's a year in. Should he be touching base with his mortgage broker and checking if there's a better deal, or is it too soon?
Oh, absolutely, yeah. I mean, you can refinance your loan at any point, even a month after you take a mortgage, right? It's only about $700 to $1,000 to refinance to a new lender. Sometimes you don't want to do it if you pay the lender's mortgage insurance or you haven't got the equity or etc. But absolutely, you should always be considering refinancing, right? From a bank point of view right now, the pricing isn't as sharp or hasn't really, a mortgage war hasn't kicked off. We saw snippets of maybe that was going to happen about a month ago. There was a very good deal that Westpac were offering. It was a limited time only. And usually those things aren't for a limited time only. They just roll on. But they offered it and they actually removed it from the marketplace. And so bank pricing isn't super sharp right now. There's not a huge mortgage war. You'll know when that's happening. It'll be everywhere. So right now, I reckon your rate's probably pretty sharp compared to what good rates in the market are. And refinancing after a year, there's only a slight benefit with re-extending your loan term and reducing your repayments. So I probably wouldn't do it for that reason. The only other reason you might want to do is if you build a lot of equity in the property. And so unlikely in this market. Maybe, there's always micro markets where properties have gone up. I don't know if you think yours has gone up based on some past sales.
Potentially, yeah. We had one sell not too recently for more than we bought it for. And we've actually had almost every agent in the area ring us off the back of it being like, do you want to sell?
That's interesting, right?
Agents ringing you is just it's
like, have you seen what happened down the road? Do you want to sell? It's like, no, dude, we literally just bought this joint.
Yeah, okay. So that's actually a really, ideally two. One's good, one comparable, and it sounds a very similar one, like very close in distance. And usually, I know what you own, and a lot of those properties are very similar in terms of land size and floor plans. And so, if you get a good valuation near your property or a good sale, it's always good to test it with a bank val, because if the bank valuer looks at that property and says, oh yeah, actually we can value your property, that is, you potentially, depending on your income and your personal situation, you could release equity based on that val. And you never know if it's a one-off sale or markets could go back down. And so all you're doing there is just building buffers. So you don't actually pay any interest, you just release it and put it into an offset account. I I did it, personally, back in 2021/2, there's a real lot of heat in the beaches market where I lived, and we got a really strong val. We released up to 80% on that val, and that property's not worth what it is now. It's probably still worth 15% under. So we've got a loan on it up to probably 95% of its current value, because we borrowed up to 80% on what it was worth at the top of the market. And that money just sits in an offset account.
So that's what happens when you release that. You can just sit it in the offset. You still have to service it though.
No, because the money in the offset basically
yeah.
just pays that loan off, and and if it's interest only loan, then there's nothing to service. Because you release 200 and you got 200 in your offset account, and so you may.
What if it's P&I?
P&I, if it was let's say the repayments were $3,000 a month, probably wouldn't be that much. Let's say $2,000 a month. That money would just go $2,000 out of the offset account and pay off the loan $2,000.
Yeah.
And so now your loan's $198.
Yeah.
And then next month will be $196. So it doesn't cost you anything because there's no interest. All your repayments are doing just paying off the capital. Now, the banks don't do margin calls on property, right? That would be a huge concern in the property market. And that's one of the obviously the dangers when you're buying shares, right? If the market tanks. But even though my property value fallen over 20%, to be honest, the beaches market got hit really hard. Particularly where I am in the northern part, my loan is pretty much, I would say it's 100%. To be honest. But the bank isn't going to come knock on my door and say, hang on a sec. Your value of property's fallen 20%. Your loan's now 100% of the value of the property. I want you to reduce that, right? Because I've got a 30-year loan. And so I've then got that cash there available. So if I wanted to put that into other property, if I want to do a reno, if I want to buy into shares, I can do that confidently because I've got that cash there. So that's always a good idea. So just from best practice with mortgages, anyone listening, if you've got a property and you find you're getting some really good sales near your property, it's a great time to go to brokers after that and say, hey, can we just do a couple of hours?
Is that cost free? Is that
pretty much? Yeah. Sometimes non-banks and things might charge some money to do it, but ultimately you probably want to play with the big players, and a lot of them will do it for free because the reality is they're thinking, hang on a sec, we'll do this fast. Sometimes they're desktop, so they're really cheap for the bank. But even if they get a valuer out there, the valuer gets paid peanuts. They get a couple $100, right? Particularly on properties, under a few $1 million. They're coming in, they're walking around, taking some photos. They're out within 15 minutes because they just don't get paid enough. And so they're not doing a ridiculous market research. They're just saying, okay, you said it was worth, 2 million or 1 million. I've got some comparables. I think it's worth 1.9. Sometimes values are always going to be a little bit conservative. However, sometimes they just, they're so busy. They're just going, hang on a sec. Yeah, 2 million sounds fine. Next property.
Yeah, okay.
And so always try your luck.
All right. Well, there's something for you to do when you're in, Bryce.
Yeah. I'll definitely do that. But I mean, similar in your situation, like you could probably have a look at yours with,
Oh, well, now that I know it's free, I'm going to be doing it monthly.
Particularly if you get a buyer's agent that comes in and actually gets it like a decent price on it.
Yeah.
Like you're probably up when you buy it in some way, shape or form.
Ideally, you want that short-term market movement. And, I wouldn't be too concerned if you don't get that right. Like markets can change in short cycles. What you want to know is, is this asset really scarce? Is it a good asset long-term? But if you do see there's a real movement in the market, that's one of the best ways just to protect yourself because you can get your deposit back. Like you could basically get yourself in the same cash position as you were going in by releasing that cash, which you might want to put back into shares or whatever it might be. And so that's one of the things where people go, I don't want to ever buy property. I'm just going to go into shares, which is fine. But when you do go into property, it doesn't mean you've lost that money forever. So once the value of that property goes back up, you can easily release that money back up and then buy the shares. So you can have property and you can have shares.
Is this something I would just email you and you guys organise it, or do I need to do it myself?
No, you just say it on the podcast and it'll happen.
Yeah, nice.
So we went with a certain bank for you because there was certain benefits around the way they look at lenders' mortgage insurance, etc. So we'd just go back to that bank. It's been a year.
But I mean, do I personally do it?
No, we do that.
Yeah, you do.
Yeah, absolutely. Yeah, we just lodge it, and it's really simple.
Well, we should actually just pause here and say, if people want to speak to Chris and his team, if they want him to get a valuation done or speak about a loan, go to equitymates.com/advice. And we can put you in touch as well. So it's not just Bryce who can ask Chris to do it. Now, Chris, as I said at the top, we've got a bunch of questions from the community, and a number of them are around getting into the market. So the first one is quite general. They would love a novice guide of where to start when looking for property market entry. So it's broad. How does someone who's not experienced get into the property market? Maybe in a short version.
I do think you got to not lose hope here, right? I do think that, yes, absolutely, you would love the 800 square meters north facing in the most premium part of our capital city with, 4 bedrooms, etc. But sometimes it's unrealistic, right, when you're starting. And ultimately, I think there is a lot of misconceptions around what you need for a deposit. 45 years to save for a deposit, all that sort of stuff isn't true. There's a lot of help around stamp duty concessions on where you live around the country, if you're a first home buyer, and there's 5% deposit home loans, right? So, rather than saying in your head, I can never buy a property, well, actually just understand what options have you got based on your income and where you're buying around entering the market around deposit. Now, if you've got that deposit, it's then just looking at your income and any things that affect your serviceability, HEX debt, credit cards, car loans, and going, look, based on, do you do it by yourself, or do you do it with your partner, or do you do it with your brother or sister? Like, do you potentially move back in at home? Do you look to buy an investment property versus a home? So there's lots of different ways to enter. You don't just have to think, I can't afford the house I want long term, so I'm never going to buy. And so that would be my first thing, is trying to change some misconceptions there. The thing I would urge people to do, though, is don't just try to solve the pain and buy any property. I think that's absolutely what I think a lot of first home buyers get wrong, is I need to buy a property, they rush it, they get pre-approved, they go online, there's so many people spruiking property, all of a sudden they've had a conversation, they have an amazing pitch and research on what to buy, they buy a property and then they forget about it. And, with shares, you get that instant market awareness, right? It's on my phone, right? With property, a lot of people just sit and forget, right? I never sell a property, buy and hold, all that. And the person selling it said, you got to wait 5 years. 2 years down the line, they go, hang on a sec, I bought that apartment off the plan. Actually, there's a lot more coming. It's still worth what I paid. And they've completely blown it because they rushed it. So I do think part of that is getting ready financially and making sure you understand what options you've got. And two, once you do have those options, is making sure you really understand what's a good asset. And until you know that, I wouldn't enter, to be honest. And how's that property going to really work for you? Are you going to just buy another investment property after that? Are you going to then sell it to, upgrade? Are you going to do a reno to it? You've got to have a very clear strategy on why this property works for your life.
Well, a couple here that we'll kind of group together. It's around, young people getting in, first home buyers. So what are some pathways that you see for young people entering the property market, but also what areas of the market at the moment are you seeing first home buyers having success in, if that makes sense?
Yeah, so there's a lot of first home buyers who are becoming first time investors at the moment. I think there's a lot of apprehension to buy for first home buyers, which is understandable, right? Maybe work prospects aren't as positive as they were 3 to 6 months ago. Interest rates are really high. They are moving into share houses and they're keeping their rent really low or moving back in for home. And so they don't really want a huge expense at the moment. So a lot of first home buyers are becoming first time investors. And so we're seeing investment lending really high. And I think a lot of that is because of the proliferation of buyers agents out there producing content, right? And you can see that in terms of the stats in places like Perth and Adelaide and Brisbane to a lesser extent. And so they show investor lending is really high. But I actually think that's a lot of first-time buyers driving that who actually... And the problem with that is those markets is they're not long-term investors. They've only gone there to enter the market. And so when they believe that the returns aren't there, they're going to bail. And so those markets, I'm a little bit nervous for them, to be honest. I think a lot of them are entering the party quite late. And when those markets do cool, because the investors aren't buying there anymore and the locals can't afford it, or that local sub-market, I do think they're going to regret those decisions, to be honest. So that's what a lot of first-time buyers are doing. If they're buying properties to live in, we have seen the suction back to sort of the capital city. If you go back to 2020, 2021, even 2022, a lot of people were going to the Central Coast, the north of Wollongong, the Mornington, Geelong. I do think that return to work, sort of getting back to the office is really strong, much stronger than I thought, to be honest. I thought hybrid work was really embedded and remote work. I think that a lot of first-home buyers are wanting to try to stay close to the city. What are they buying? They're absolutely... Housing's really hard, right? Like, if you're wanting to enter into the housing market, so they're looking for bigger, apartments in sort of smaller complexes and typically close to the train stations as well. And so I think that's would be, if I was a first-home buyer right now, that's what I'd be trying to look for. The good news is we're seeing a real... reduction in, future capacity in terms of building, right? So, developers can't really build many apartments right now, unless they're going for the high end and they're building in Double Bay or the, Potts Point or Mossman, etc. That's sort of more high density and, lots and lots of apartments coming. It's just not stacking up at the moment. And so I think you've got a real, tightening up of supply and real strong demand building from first-home buyers.
Not sure. I would debate whether that's a good thing. Yeah. But I guess for prices, it's a good thing. Yeah.
Oh, we absolutely want to be building more and more. Hence why you've got zoning changes with Christmas and governments and, in Victoria, they've just done some stamp duty savings for apartments, etc. Because absolutely, one, it's good for the construction industry and the jobs and our economy, which is what the government really cares about, and the taxes they make. But B, we need more supply, right? That's one of the issues that we've got coming into this market. It's just very low listings of things that young families really want. There's still issues around Sydney, though, where you've got too many apartments. You think about Epping and Parramatta and even around the airport. There's just too many apartments.
Right.
Like they're empty or...
No,
there's just that there's no price growth there because ultimately there's not an undersupply, right? So, even though in the last 3 years you can see a boom in prices, you go look at those markets and those apartments haven't gone up.
If we specifically stick on first home buyers, there was a group of questions around boosting buying capacity. And there were questions about some of the different schemes around the first home super savers scheme. Also some general questions about what young buyers can do to improve their borrowing capacity if they're sort of, 6 to 12 months out from wanting to buy. So let's take them together. When you see a young person, first home buyer, young couple, and they're sort of in that 6 to 12 months out from buying, what are some of the tips and tricks you suggest that they do to maximize their chance of getting something?
Yeah, so I think once people understand how borrowing capacity works, then they get it. There's only so many levers you can pull, right? The thing that matters the most is your income, right? And so trying to, understand how banks look at it. So you're an employee, you could be a contractor, you could be running your own business. And so what you really want to understand is how a bank's going to look at you. So if you are going to change jobs or you're going to go and start a business, just be really understand how that's going to affect your borrowing capacity. And it's not as black and white as you think. Sometimes people say, I can't go contracting because a bank won't lend to me. That's not always the case. Some banks will lend, particularly if it's just one contract, it's more than 6 months, it's in the tech industry, etc. So if you're thinking about buying, just understand how your income's going to look from a bank point of view. If you're employed, it's really simple. You don't have to be concerned about probation, if you've got a good, strong work history. But switching jobs could mean you lose entitlements like commissions or bonuses. And banks won't lend on OTE. What your earnings would be if you get paid that bonus. They'll want to see a history of bonuses. So be really careful, switching jobs if you're thinking about doing lending, if you've got a big commission or bonus element. So the first thing you do is try to maximize your income because that's what's going to drive your borrowing capacity the most. The second thing is if you think about what you've got income and expenses, it's just looking at those sort of fixed expenses, like usually lending where a bank's going to say, hang on a sec, I've got to factor that in. So you don't really want to go and take out a car loan. If anything, you want to get rid of that car loan and just have a cheap car that you own with cash, right? You don't really want to have major credit card limits. Not what you owe on credit cards. It's what the limit is because the bank says, well, you could spend that tomorrow. We need to base your application based on you spending that. Yeah. So reduce all your, and just cancel your credit cards or have a $500 limit or something, right?
The debt one that always gets asked is HEX.
Yeah, and there's some interesting policies have come out recently. So there's always, government reviews on things they can do to, help first-time buyers. And and I was actually reading some articles last week. I'm not exactly sure where it was, but I think it was actually in the Senate review. And there's a little bit of a push to remove HEX out of servicing for first-home buyers. There's also a little bit of a push to give first-home buyers 40-year loans, which sort of makes sense versus... upgraders. So giving more advantage to first home buyers.
Yeah.
Even APRA came out, there's a bit of a war around should the serviceability buffer be 3%? Given we're at the top of the rate cycle, let's call it, and rates are likely to come down, do they reduce that buffer? 2 banks said yes, 2 banks said no. But I think that there's a little bit of a push to maybe, for first home buyers who careers are early, maybe they should be able to leverage up a bit harder because they've got income trajectories higher.
I have thought about the loan length because it feels like something you could pull pretty easy to reduce the burden on cash flow. But why is it? What has led? Why is it a fixed 30?
I think that's the, there is some banks like Ubank, I think, have come out with a 40. So I think the banks can do it because banks are always going to make tweaks, right? Their game is lending, right? Lending growth.
Yeah.
And the way to lend more is to increase borrowing capacity.
50-year loan.
Yeah, and so I do think that's gonna be coming down the line.
Yeah, as long as they still got people to borrow to their absolute maximum capacity, because what they don't want is you borrowing the same amount that you would over 30 years, but spreading it over 50 years, because that'll affect the bank's cash flow.
Yeah,
but what they want is you to lever up, like to borrow even more, pump house prices even more.
But I guess if it gets to a point where it's either 40 years or this person doesn't borrow at all.
Well, no, but that's not the bank's counterfactual. The bank's counterfactual is they lend to you for 40 years, or someone is going to buy that house one way or another. Yeah. And they hope that they get that business.
Yeah.
But either way, the house is getting bought. Yeah. Anyway, Chris,
Yes,
this is not the point of the episode.
Yeah.
How early should people be speaking to a mortgage broker? Like, is it when they've got a deposit saved? Is it when they've got the glint of an idea of property in their eye? Like, what's the right time to speak to a broker?
Look, I think if you're in 30 grand of credit card debt, you've got lots of job insecurity, and that's probably not the greatest time to go and speak to a broker, right? I think there's some other fires you probably should focus on first. But let's say you're on top of your personal debt, right? And you're starting to save every month, and maybe you haven't got the saving that you wish you had, but you're on that trajectory. And you're starting to think, maybe in the next 12, 18 months, I really will sort of want to enter the market. I think, like a fitness goal, right? I think speaking to a broker that can go, you know what, if you wanted to buy today, you would need about 100 grand, right? And you're at the moment, you're at 40. That's going to motivate you more, right? And so I do think once you're sort of at that saving part and you're on top of your day-to-day spending and you're starting to save, and you're thinking properties that just go and understand your deposit, and also then talk through, okay, this is my plans for the next few years with work. How would a bank look at that? And if they go, no, there's no issues with that, you can start to, I've actually seen, clients will say, okay, well, that's it. I know I need to be earning X. What do I need to do to get myself into a position to earn that with work, whether it's study or whether it's taking on more responsibility? And it's, there's a joint focus. I'm trying to save hard, but I'm also trying to increase my income because I know I'm going to need that for the bank. And so it's a double win by speaking to us.
Okay. Well, if you do want to speak to Chris and the team, head to equitymates.com/advice and we'll put you in touch.
We've got a few more general questions, Chris, before we do get to the Matt Barry response. We've kind of touched on this one, but are you seeing any major trends in lending policies that could be affecting us over the next few years?
I think there's some really innovative lenders' mortgage insurance products coming out, particularly on the higher end, which, if you asked me 2 years ago, would we ever see that? And I would have just said no. It's an ANZ 95% lending up to 8 million, which is just crazy. It's on certain postcodes because they believe it's low risk and they want to bank that type of customer. So that's crazy. It's absolutely risk on with the banks. We there's been changes to make lending to self-employed borrowers better based on their salaries, not based on their financials. And so lending goes through cycles, right? Risk on, risk off. Risk off was when COVID, March 2020, right? We're not lending to these industries. We're not lending to anyone on contracts, etc. Risk off was 2018. That was a horrible time to get lending in the Royal Commission and around expenses, and the banks were really scared. And but right now they're risk on, right? It's pretty low risk lending for the bank right now because we're only borrowing, 4.5, maybe 5 times income. If you go back even 3 years ago to 2021, we're getting lending at 6 or 7, even up to 8 times income. If we go back to 2014, we were getting lending 10, 12 times income. Whoa. It was just unbelievable.
So another question we got was around buyer's agents. I guess specifically around what someone should be paying, like what a ballpark reasonable cost is if they get it from a buyer's agent. And then if you just got any thoughts on them generally, but yeah.
So they do vary around the country in cost. Melbourne's a bit cheaper. Sydney's obviously a bit more expensive. Brisbane's probably in the middle. Some people probably argue with that, but I do think they're a little bit cheaper in Melbourne, right? And they're more established. There's a lot of competition in the market there. So, what's a fee? I mean, you're probably looking at 10 to 15 or something in Melbourne, to be honest.
Grand.
And
So it's not really,
thousand.
it's not really a percentage of the purchase price. It's just a cash.
Yeah, I mean, a lot of people just do that. They will say, it's between 1% to 2%. But then what will happen is particularly as your purchase price goes up, right, you should be able to negotiate a flat fee.
Yeah.
And I'd absolutely negotiate with buyer's agents just because there says on their cards this fee. There's nothing stopping you. And I would personally say, right, can we just come up with a fee that we're both happy with, right? Just be careful that you don't, like any profession, don't just pick based on fee. And there's a human bias there that we absolutely do that. They're a bit cheaper. It feels lower risk. Well, what you're doing is the risk is here. You're paying someone a bit cheaper, but you're not getting the experience that you really need in buyer's agent world, right? So pick based on their experience, their local market knowledge, their how long they've been doing it in that market. And, are you dealing with someone more established in terms of the business owner? I think that really matters in buyer's agents. I think if you go to a bigger firm that you've got some superstar sort of person who's driving the firm, doesn't mean that their knowledge is across all their buyer's agents. I think it's a hard job to scale. So I would be going with a small practice, someone who's super experienced, 5-10 years, not one of the newer buyer's agents, and local market knowledge. And then sense check it. Speak to some local agents in the area and just ask them, what's some buyer's agents that you consistently see? What's your thoughts on them? And have you worked with so-and-so before? Because some of them will be like, no, I haven't worked with them. They'll like to... buyer's agents and real estate agents usually don't get along. But the good ones absolutely get along with these agents. And so pick someone based on that. Don't pick them based on their fee. And because a few $1,000s more for the best in the game versus someone who's new is worth it.
Well, I mean, we had a buyer's agent, my partner and I, that you recommended, and we had a great experience with him. So I guess you should also ask your mortgage broker if they have worked with anyone or have any recommendations.
Absolutely. I do think, though, unfortunately, mortgage brokers still are very in the early days of understanding what buyer's agents do.
Okay. Well, let me correct what I was going to say.
Yeah.
They should speak to you and ask you if you have anyone, and they can go to equitymates.com/advice to do that.
Yeah, I'm trying to improve the broking world understanding of buyer's agents. I've been working with them since 2012. A lot of brokers just have one buyer's agent. They don't go and do all the due diligence to actually go and build these networks. So it takes time, and they end up just referring to one company and someone who actually pays them. Just be really careful that, why are you recommending this buyer's agent, and are they a local market specialist or some group? If it's just some group, just be really careful.
Nice.
Final community question is, do banks take into account the money that you invest when applying for a home loan? And I guess not from a cash flow point of view, but perhaps if you have a share portfolio, does that help in any way? Potentially.
They are lending a bit more on, people who have got, shares as part of their income. You think you might be working at a Canva or a Atlassian or something, or a Google. They're using that so that those shares that you get as part of your income is the RSUs. They're getting back lending on that again. So that's another sign banks are risk on.
That's dangerous.
That changes in time. If you've got a $500,000 investment portfolio, they do a deeming rate on it, but it won't increase your servicing that much, right? Very little. Depend on how much money you put into the property. So if you borrow at 95%, you'll pay a higher rate. Your servicing will be affected by that. But if you put in a 30% deposit, it'll be a lower rate, and absolutely you could borrow a little bit more. It's not a huge amount. The more deposit you put in, the more money you can borrow. There is a cap on that. But around that sort of 80% limit, you will usually be able to borrow a little bit more.
Yeah.
Well, Chris, we teased it earlier, but we do want to get your thoughts on the Matt Barry conversation. Now, we'll include the link in the YouTube description and the podcast show notes if people want to listen to the full Matt Barry interview. But I think in a very short nutshell for people who haven't listened, Matt thinks that the high price of housing in Australia kind of is the root of a lot of our economic problems. It bleeds into the sort of the cost of everything because, everyone working in Sydney needs to afford a house or rent in Sydney. And then he also thinks that the property boom is unsustainable just because of the high prices are simply becoming unaffordable. And he thinks there's going to be a correction at some point. I think that's a fair summary. So you had thoughts, so we'd love to hear them.
Look, seeing Matt on YouTube, I wouldn't want to go in the ring with Matt. So let's just make this a chatting discussion versus a true blue in the red corner. But Matt makes some really good points, and I actually agree. And I've said these things before. Property market is a Ponzi, right? Because you need more and more entrants. Hence why we've got the migration scheme. I absolutely have said it for years around. It's becoming more and more of a social problem, right? Like if you can, when you look at a city of where in the world do I want to live, right? Okay, yeah, I can move there. There's great job prospects. I'm going to earn this salary. Okay, but what are going to be my expenses? And if even finding somewhere to live, and it's going to be ridiculously expensive, and it doesn't suit what I need, that market from talent, global talent goes off. And so I think there's not only people leaving Sydney, you can see interstate migration out of New South Wales is happening, right? And this is what Chris Minns has been saying in terms of his rezoning, right? He's saying there's a brain drain coming out of Sydney. If we don't make housing more affordable, then people are going to keep leaving. The other issue is that it stops entrepreneurship, right? Because ultimately, if you've got a big mortgage, particularly we get to the family stage, do you go and start a business? Yeah. No, you've got a mortgage, you've got commitments. And so I think that's it. I do think there's the property market, like I said before, is 11 trillion. Once you do make money in property, you don't go take that money and start a business or put it into shares or your super. What you end up doing, because of the cost of property, you just go reallocate it back to property. So the mental accounting and just the need, even downsizers, right? They're struggling to take much money out of the property market, right? And so I absolutely agree with all that. I don't agree with just because the math said something expensive means that it's going to blow up. And it doesn't mean just because new entrants can't afford prices that everything's going to blow up. I do think the turnover rate of property is reducing every year. Yes, we are living longer, but there's not an alternative for these people. Unless people are going to leave Australia, then they're going to have to live somewhere, right? So the demand for housing is still there. The aged care system's not encouraging people to downsize. And so I think, Matt said, there's not a need for more demand for property. I don't think so. People are still having kids. People are living longer. They're not downsizing. And then there's more and more people sort of moving here. The misunderstanding of how much intergenerational wealth is built in the property market and how that's going to get passed down in the next 10 years is when you think about the markets, we have 11 trillion, but it's only $2.5 trillion of debt. I think, you can see the ownership rate is still been reducing. So as the ownership rate reduces, right, it was 70, now it's 60, and it's dropping, particularly for younger people, they still want to buy. And so there's huge pent-up demand in the property market. And I think you've seen with the attack on investors over the last 10 years, all the way back to 2015, is it's getting harder and harder to rent, right? It's, hence why we've got build to rent coming out, etc. So I think the fundamentals are all still there. If you said that we weren't going to change the system, as in we weren't going to increase the population and there wasn't going to be migration, but I think Matt just argued why that's not possible, right? Once you're on this system of, education, construction, the banking system, or the property market, how can you change the Australian economy? It's what are we going to do? Go back to manufacturing, etc. So I think that's the issue. Just because you don't like the system and the game is not working, it doesn't mean it's not going to change. And I would say I'd rather play the game rather than just hate the system and say this is not ever going to work. I'm not going to ever buy property because I just don't like how it's ruining the Australian economy. Because you could just sit on the sidelines and be like Matt and say for the last decade, and Martin North and Steve Keen and a lot of property bears who are anti the system, but that doesn't mean that prices are going to go down. And I think that's the danger with listening to that too much, because what you end up doing is you get confirmation bias, right? You follow that, then you'll go read some Tarot Booker, or then you'll go read another property bear and another property bear, and you'll fill your world with this negative energy, and then you'll get 5 years down the line and go, oh, that's not what happened.
Missed it.
I've really not. And this is what happens in share markets, exactly the same thing. China's going to go down, Trump's, you could absolutely read two different publications. One's that, and then you could read the stock market bear story as well. And a lot of those people never buy in the stock market because they're constantly waiting for a crash, and then it never happens.
In our second book, Don't Stress, Just Invest, we wrote, whatever you think of the system, change is slow and our lives are short. So you've got to make the best of, what you're in. And I think that's a classic example here with the property market. It's like you can agree with everything that Matt has said, but to what you were saying earlier, like if it doesn't change anytime soon, like you don't want to sit on the sidelines and miss out. So yeah,
and I
think buy the house, buy the shares, and then go to the protest, and then run for office. Is what we're saying.
Yeah, and I just think the property market it's driven by owner occupiers, right? So people still need somewhere to live, and COVID was a great example of that. Is that the economy outlook was really bad. It doesn't mean people then rush to sell their homes, and so what you saw is supply tighten up, and so as people the gap to jump is getting further and further. People go, I don't want to rent, but I'm just going to stay in this property. So the turnover rate of property is getting tighter and tighter. I didn't agree with what Matt was saying is we're in some building boom. We're building comparatively to other countries around there. We've got one of the fastest growing populations in the country, right? And there's a huge desire to own.
I think his point was more that like the political answer to this is we'll build our way out of it. We've got to build more. But he's like, we can't just build more. We're already building almost as fast as any other country. And it's like, you can't just say we're going to build another 200,000, 300,000 homes on top of what we're already doing.
Yeah, absolutely. That capacity restraint is real, particularly when you've got things like the Brisbane Olympics and metro.
Victorian infrastructure.
Exactly. And that's pushing up the cost, right? And they got all the issues around materials, not just Australia building. There's lots of countries around the world that are building, right? And so what we can build is even if we go to the peaks of a 2017, that's probably what we need to be building consistently every year. The 1.2 million homes over the next 5 years, what are we going to build? Maybe 1 million, maybe 900. It's nowhere near this aspirational target.
Nice. Well, that's a good place to leave it. And we really appreciate you coming on, Chris. A couple of takeaways for me. I'll be emailing the team to see if I can get a valuation on the place. And also, if you want to chat to Chris and the team, head to equitymates.com/advice. We'll include a link in the show notes. There's a form there to fill out and we'll get you connected. But as always, Chris, absolute pleasure. Thank you so much.
Great to chat.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.